This is like church. Everybody's crowded into the back.
Or class.
All right, well, why don't we get started? I'm going to start out by introducing myself and our esteemed guests here today. But the format today is going to encourage very significant interaction. As we were talking earlier in the week about what we should talk about, it occurred to us that there's probably a wide range of knowledge and expertise in the audience here today. I see a few folks, Larry Fisher and Jamie and others who are investment professionals and others who are not. So after I make the introductions, and I'm going to then ask each of these guys to explain to you all a little bit about their companies and what each of us do in our companies. And then we're going to ask you some questions and get a sense of your knowledge and what you're interested in talking about. And after that, we'll see where it goes. I've got a list of about a dozen questions if you guys are shy or don't have a lot of questions. But I think the idea here is not to have a lecture hall, but instead to make this interactive and talk about the things that are of interest to you all. So with that, I will introduce myself. And I'm Bob Steers, and I'm the CEO of Cohen & Steers. My background is that I started out a long time ago as a research analyst at Citibank. And about 30 years ago, a fellow who started the same day as I did at Citibank and I started our current company in 1986. And the idea back then was that commercial real estate was owned back then virtually 100% by private institutions, banks, insurance companies, endowment funds. And we felt that real estate would become securitized or publicly traded because it's an income-oriented investment. And if there's one thing Wall Street does know how to do, it's to put a value on an income stream. So we started our company in 1986 to focus on investing in publicly traded REITs. Today our firm manages about $53 billion. We invest in a broader range of real asset strategies, so that would include real estate, infrastructure, commodities, natural resource equities, MLPs, that sort of thing. And because securitized real assets, real estate have gone global, so have we. So we have offices in New York, London, Hong Kong, Tokyo, and Seattle. And we went public about 11 years ago, and that's been an interesting experience. It's worked out well, but it's an entirely different world. I'm delighted that I'm part of Canterbury's investment committee, and I chair Georgetown's investment committee as well. So that's me. Mario, I'm sure many of you are familiar with Mario Gabelli if you watch CNBC or invest in mutual funds, and you are undoubtedly aware of Mario and the success of his firm. But let me just run through for you. Mario is chairman, CEO, and grand poobah of GAMCO Investors, which is a global financial service company managing...
You can change the name of Cohen & Steers any time. Just make a bid.
We'll talk later. Mario as well manages over $50 billion. He's a graduate of Fordham University's College of Business Administration, an MBA from a place uptown in New York, Columbia University. And Mario serves on the boards of Boston College, Roger Williams University, Columbia University Graduate School of Business, the American Italian Cancer Foundation, and many others. He was Morningstar's Portfolio Manager of the Year in 1997, named Money Manager of the Year by Institutional Investor in 2011. Again, he's a regular guest, I think a market master on CNBC. And Mario is a former Canterbury trustee and proud father of Canterbury graduate Matthew of 1989. And just in case you didn't get it, the panelists here all have a connection with Canterbury, either parents or former parents or what have you. Doug on my right is president of Point 72 Asset Management in Stamford, formerly SAC Capital. Prior to Point 72, Doug was a director at McKinsey & Company. Doug earned an MBA at UVA's Darden Graduate Business School. He's, as with Mario, a very active community member, dedicating himself to supporting veterans initiatives. In addition to serving on the board of Robin Hood Foundation, Doug helped launch the Veterans Advisory Board, raise millions to support veterans returning from Iraq and Afghanistan. Doug also works with New York-based companies to create more jobs for veterans. He serves on the corporate advisory board of Darden Graduate School of Business. Let me catch my breath here. Singtel's Technology Advisory Board, the board of the Center for Global Enterprise. Doug is a fellow board member here at Canterbury, and he's the father of Canterbury graduate Lydia of 2014, who's currently at Trinity College, and current student Amelia, who's the class of 2016. So, that's us. Why don't I start with you, Mario, and maybe go into a little more detail, about what GAMCO does, what it doesn't do, and what your role is in running the firm. What do you do every day when you show up to work?
Well, I used to work, Bob, from 7 in the morning till 11, but now that they have these machines, we call them iPads, they basically, I've changed my schedule to work from 5 to 9. It's not complicated. No, because you want to keep in touch with the world and want to know all the dots and connect them. But just before we go on, I'd love to know, how many are in the investment business in one way or the other? Oh, come on, you manage your own money, don't you? You throw darts. There we go. Passive investors, active investors. I started right after school. I graduated on Friday, and on Monday I went to work at a firm called Loeb Rhodes. It doesn't exist anymore. Neither did the other one I went after. And essentially, I started covering the auto industry. I was assigned as an analyst, which, like Bob was doing real estate. I started at an institutional firm, which meant you wrote up reports on companies. So I would visit, as an auto analyst, every company somewhere in Detroit. And during the 1960s, there were some challenges in New York in the streets. My first visit to Detroit, I would drive looking for an address. You didn't have iPads and Siri telling make a left or right or whatever my son did this morning to get up here, even though he forgot how to do it in 2 turns. And there's a fire in the street. Cars have overturned. This is Detroit in the mid-60s. I just kept driving. It's just like at home. Anyway, I covered the auto, farm equipment, then picked up the entertainment. I went to another firm called William D. Witter. We merged into Drexel, and I started a sell-side firm in 1977. Went public in 1999, so you can blame it on me. And the Sarbanes-Oxley has created a lot of problems for entrepreneurial firms like Cohen and Steers and others like ours. What we do is cover industries globally. A simple concept. If you drink it, whether it's wine, water, beer, soda, booze, anywhere in the world, and you're a public company, we follow it. So our analysts go around the world drinking. So we would own companies like Diageo, Pernod, Campari. We made a lot of money on bourbon. It was a trend we found very early. We also have other simple dynamics of content and distribution. So if you watch anything, Game of Thrones, or if you watch Downton Abbey, we would cover it, who the producers are, how are they distributed, what type of devices it's distributed on, and cover all the companies that are public on a global basis. And we do that in about 7 or 8 other core companies. My role is interesting. Team leader. So that's us.
Doug?
very nervous about following Mario. When you came in, you saw the sign that said Wall Street Titans. That was because they thought that Wall Street Titans and that other guy seemed like a strange title for a son. I've only been in the asset management business for 1 year. I joined Point 72, which is Steve Cohen's family office, about a year ago after 22 years with McKinsey. My time with McKinsey, I found myself on the other end of the dialogue between the buy side in the industry and the companies, working with investor relations and C-level executives to prepare for conversations with Mario. I wound up retiring from McKinsey partly because 6 million frequent flyer miles seemed like enough, and partly because I was just ready to move into an investing stage of my career, and I was delighted to wind up at Steve's family office. Steve's a friend I've known for many, many years. We're an unusual family office. The phrase family office sort of conjures the notion of about 6 people sitting in a comfortable location, probably somewhere in Florida with trading terminals. We have 900 professionals. We've got 200 investment professionals. We operate around the world. We have formal offices in New York and Connecticut, Singapore, Hong Kong, and Tokyo. But we invest in every region. We're also, most people think of what we do as a hedge fund, but that's only about 2/3 of what we do. The other third is spread between a small macro desk, a venture investing fund, a private equity fund, and a pretty large quant or systematic trading operation. So we have a large number of different investment sleeves. Most of it revolves around investing in equities, with the exception of the small macro desk. We really invest in equities in just about every way. Oh, and as president, I think that I would call myself a team leader as well, but I think there's only certain days when I think the team is following. So
we know that feeling
Yeah.
quite well. Yeah, they say you have the gold and you rule, but that's not true.
not always true.
Well, I'm probably in the same boat as somewhere in between you guys. So the genesis of our firm was that investing is hard and that most managers don't deliver anything of value, and that to succeed in the world we live in today, in the investment world, in my view, is facing its Kodak moment, where technology and developments in the industry are making many, if not most, of the investment managers in the world obsolete. And so today you need to decide whether you have what it takes to deliver so-called alpha in a substantial way. And we believe we do, and we try to do it by stacking the deck in our favor. And the way we try to do that is to avoid investing in core style boxes, the traditional, and in a second I'd love to hear Mario's view, because I think Mario competes in one of the most difficult, most competitive areas to compete in, and has flourished. But most, in our space, and all publicly traded, but real estate securities, infrastructure, which is MLPs and port owners of ports and airports, commodities, resource equities. Today, still a majority of managers beat their benchmarks and that sort of thing. They're very inefficient, and so we operate in areas that are inefficient. We try to stack the deck by having more analysts, more portfolio managers, more traders located in the regions of the world that we're investing than anybody else, especially in real estate, because it's a very local business. And so when you think about the rules and regulations, Sarbanes-Oxley, but Reg FD, where supposedly disclosure is even for everybody, it's just not true. It never has been, and I don't think it ever will be, because our mission is to operate with more and better information than anybody else, so the inputs to our models are better, because generally speaking, nobody's that much smarter than anybody else. Maybe Steve Cohen is, but So at the end of the day, we operate in areas where we think we can generate 200 or 300 basis points, 2 or 3% consistently over what an index could get you. And we've made the determination that if you can't do that, you should sell your firm. Get out now while you still can, because passive and other strategies are going to Pac-Man you. And so that's the genesis of our firm. We have nowhere near the resources Point72 does, but we have about 300 employees, and they're mainly investment guys located around the world in the places that they're investing. Like Mario and Doug said, I've been kicked upstairs. I've done pretty much every job anyone does, from analyst to PM to taking out the trash. But now if you're public, our market cap's only about $2 billion. But whether you're 2 billion or 10 billion or 30 billion, it's a full-time job. And so I've had to learn how to leave the exciting, fun investing part behind and manage. And managing is really hard, and it's not a lot of fun compared to investing. So I'd love to hear your thoughts on the Kodak moment, and how do you compete in large cap world?
It's not complicated. We are basically probably get incomplete in managing the firm, and I'm the CEO and chairman, so it is what it is, but I have 98% of the vote, so nobody's going to change me again. You want full disclosure? That's full disclosure. What we did was take a page when we started the firm out of McKinsey, Bain type, and that is, what's the world going to look like in 1977? What's going to look like 10 years later? And so sitting here today in 2015, what's the world going to look like over the next 10 years? Where do we want to invest? How much do we want to invest in sustainability for planet Earth? How much do we want to invest in the aging population? How much do we want to invest in the growing middle class of India and China? So we take intellectual talent, migrate that intellectual talent, if we haven't already done so, into areas of interest.
So is this like waves of change that you're
No, not necessarily. It's like, there's about 3 billion people in India and China. Okay, 1989 was the Berlin Wall came down, Tiananmen Square was in June of that year, and you knew at some point, that's when Matthew was graduating, and you knew that the world would change because in terms of allocating capital, you had a shift away from a centrally planned economy. And if anybody wants to see a centrally planned economy at work, go to Havana. I mean, it's just an easy flight. You can see what happens how capital is allocated. So we basically said, look, as time goes on, like the end of a hockey stick, each 1% change in real disposable income, when you get past the notion of food and housing, you're going to spend money on leisure pursuits. So there's 1.5% elasticity. So we started assigning teams to cover the airplane business. So we have 3 or 4 individuals that cover everything to Boeing, everything to Airbus. What and how do they buy parts? And who will buy it? Why do they need it? Because if I'm a Chinese guy and I want to go to Gala, or I want to go to Cambodia, or I want to go to Milan, or I want to come up to New Milford, I ain't going to go by boat. I'm going to fly. And so that's an area that we assumed would work. Same thing with aging of the population. What will an 80-year-old do today that an 80-year-old was doing 20 years ago, and what differences are there? And if they want to do Taekwondo or go skiing, you'll need body parts. So we have a team that does work on hips, knees, eyes, and so on. And so this is not complicated, okay? The more difficult part is that when you have a company having a meeting in London or Sony in Tokyo, you want to be at the meeting, so somebody has to cover it. And we like to do hands-on, bottoms-up research. So go see the company at their headquarters, go see the competitors, and try the products. And so that's what we do, and we do it every day. We have 20 portfolio managers, about 45 individuals. We have 225 individuals that we pay. I didn't say how many work. And we hire only PhDs. And those are individuals that are called poor, hungry, and driven. But I had a teammate that went to Greenwich Academy, Wesleyan, and she said, and Columbia, and she said, how about privileged, hungry, and driven? And then my daughter says, how about PhD, Pop has go? You got that one, Bob?
I'm following it slowly. So,
So anyway, that's what we do every day. It's a very simple thing. It's called gapping. Gather the data that from public information, 10Qs, 10Ks, visit companies, go to trade shows, read the annual reports, mid-management's not complicated. Array it the way we like, that is, lay it out over a 5-year time frame, project it in terms of what is the company going to do, and then when we interpret it, we do it in a style that's been around since 1934 called Graham and Dodd. That is a fundamental research, bottoms up. I was at Columbia and I got a guy by the name of Roger Murray, and it was like the moon, the sun, and stars, so that's what I do every day. And then communicate it. That's the hard part for analysts.
so are you CEOing as well as still very much involved in the investment process as well?
I don't like being the CEO, so I do it in a very quick way. You got to see me before 8 o'clock or after 5 o'clock. I got to be ready for the market to open, and it's U.S., but we're trading around the world. And then after 5 o'clock, things slow down for 20 minutes. And I want you to think in paragraphs and deliver your question marks and sound bites. And we'll give you a quick entrepreneurial answer. And I've got individuals that run the mutual funds. I've got individuals that run separate accounts. I've got individuals that run the hedge funds. And this is not complicated. And I'll allow them
Sounds
to...
complicated.
So what? I'm the CEO of 3 or 4 other companies as well, Bob, and they're in the telecom business. And, running a business like you do and running a business like you're now doing makes you a better investor. So I commend you.
Thank you.
You learn about some of the dynamics that go on in the business world. So I have an incomplete as the CEO, and I think we're doing okay as investors. We unleveraged, diversified, compounded at 15.9% for 39 years.
You should get 2 and 20.
We get 0.80,
I know.
and they
We
tell
get
us
less.
we're overcharged. You know that.
So Doug, you're not an investment professional, but maybe if you could, before we start jabbing each other, obviously you did your due diligence before you came to SAC. So just talking about the investment process, I know you're a manager, not an investment guy, but maybe just talk a little bit about, I know it's Steve's family office, but what is it he's doing? What's he investing in?
Sure.
You've got all these employees. I'd love to know what they're doing.
Well, I don't know that our investment approach. I'm going to talk about the one piece that's probably the easiest to relate to, which is the equities investing that's done by people as opposed to the equities investing that's done by algorithms that are programmed by people. That part of our business, I don't know if that our strategy is unique, but I suspect it's pretty different from what Mario and his team does. Our style or our approach, our strategy comes out of sort of the evolution of our firm. Steve is famous for being a trader, right? Everybody says Steve was one of the greatest traders of all time. And having watched Steve and worked with Steve a little bit, and listening to him talk about the early days when he was doing a lot more active portfolio management, he really was a trader. He would watch the flows of capital through watching the movements of the stocks over the course of a day. And he has a very unique personal ability. I've sat with him for a day and just watched him, and I've seen it with my own eyes. And the only thing I can compare it to, are any of you play an instrument or musical in any way? One person, 2 people?
No, they're investment professionals.
My daughter Amelia, and I'm better known in this place as Amelia's dad than anything else. My daughter Amelia is a harpist and spends a lot of time performing with orchestras. And if you look at a conductor reads about 15 lines of music in parallel. And so as you're listening, the conductor is reading all of this processing in parallel and conducting the orchestra. And Steve's unique skill is being able to process enormous amounts of information in parallel. But Steve will tell you right away that his ability to trade effectively disappeared about 2006 or 7. And he says he remembers
Because of size or?
Because of computers entering the market. That he used to be able to watch money moving in the market by watching different values move and get ahead of it. just see what was happening and just step ahead of it with his own trading. Obviously, that requires a lot of confidence in what you're doing and sort of a will to take the risk of doing that. But he said it moved at a pace you could watch it. He said in the late 2000s, as more and more of the trading became automated, he physically saw the market change. And when the market began to move so fast that you couldn't step in front of it, he threw away everything that he did and said, I have to reinvent this firm to trade differently. The way we trade today, or the way we operate today, is a hybrid of two thoughts. There's one which is the fundamental type investing that Mario described. There's one way to view a stock, which is a stock is a call option on all the future income of a company, all the future earnings of a company, and you can value it that way. And it's very rational and makes a lot of sense. And it all depends on a set of assumptions, as Mario described, with their method of arraying the data into the future and looking at it. You can test your assumptions about what you believe about economic growth, or what you believe about this company's particular success, or even what you believe about interest rates or government policy, anything like that, and you can take those assumptions and you can say, I think this stock fundamentally has a value of X. There's another way to value a stock, which is a stock is a thing. It's an object, like a piece of art, or any unique object, like a piece of antique furniture. And under that thinking, the value of the stock is whatever somebody's willing to pay for it in that moment. And the supply and demand for that stock, as a sort of an object unto itself, independent of what lies under it, the market can move a lot based on that assumption. So if you take those two streams of very different thoughts about how to value a stock, those streams collide. We do all of our investing at the collision. We rarely own a stock for more than 100 days. And the reason that we rarely own a stock for more than 100 days is that we get excited about investing in a stock when one of those streams of thinking upsets the other and creates a big distortion. The big distortion could be a big overvaluation because the stock as the object is trading wildly in excess of what it should be, and it'll regress back to being valued more fundamentally. The big distortion could be a big undervaluation because of either a set of assumptions or a panic or a belief, or even just an anomaly in the marketplace. And because we try to invest in and around those distortions, we have to be ahead of the game every day, right? It requires an enormous amount of hustle. We probably have more analytic effort, just measured in terms of person hours, behind each dollar of asset we have under management than any other firm that I know, simply because we turn them very, very, very quickly. You could say that the era of our investing in this way is only about 6 or 7 years old. I think our average unlevered return over that era is about 25%. So it works very, very well. It's extremely demanding, and you have to have the nerve to occasionally lose a lot of money. Now, you said something I wanted to build on, though. You talked about the Kodak moment for the industry.
Yeah.
I strongly agree with that. I can also make a counter case, but if you define the industry as the U.S. equities market, I think there's a pretty good case for that. Bob talked about pursuing alpha. How many of you know exactly what alpha means, or at least close enough what alpha means? Okay, almost everybody does. If you measure alpha as a percentage of the value in the stock market, and look over the last 20 years, the amount of alpha that's available in the U.S. equities market is half of what it was 20 years ago. Half. So that means that the idiosyncratic risk, or sort of the unique variance of a single stock, is way down, which means it's harder to generate alpha. Yeah, market's much more efficient. The computers that I talked about a minute ago have made the market a lot more efficient. So if you say, well, the market in which we're investing is tougher, we better have better talent, right? We better have much more exciting talent. Well, the other side of the equation, if you look at the young people who are excited about the asset management industry or excited about the financial services industry today, it is not the people it was 15 years ago or 10 years ago. A lot of the strongest students are much more excited about starting the next .com company, or starting the next, being part of Google, or being part of a bunch of new economy type companies. So it is harder and harder to attract the best, brightest young minds coming out of the schools in the country to the industry, and it's getting harder to make money. If you put those two things together, the industry could have a Kodak moment.
Well, and I'd throw a question out to the audience. How many of you are currently or have invested in ETFs? Right, and I think that's reflective of your point that the number of managers, number of funds, whatever, that are generating the types of returns that gets investors to be loyal and excited has diminished over the years.
That's right.
And passive strategies are competing quite well, both by delivering index returns, but delivering it very efficiently, very cheaply. And so, that's a trend that's not going away. The only thing I might take issue with you on, I think Wall Street has always gone through periods of time when, when I graduated from Georgetown, it was following Big Bang and all that other stuff, and I couldn't get a job. I went right to graduate school because there were no jobs. I went to about 20 Wall Street firms, Faulkner, Dawkins, and Sullivan, and all these firms that don't exist anymore. And they all said, "Kid, why do you want to work on Wall Street? It stinks here. It used to be good. It was good here last year and the year before, but it's no good anymore." And I think these things tend to be cyclical to some extent, although I agree. I think active management, long-only active management, is not the industry it was, and I don't think it ever will be. But
well, you know what?
Hop in here.
Yeah, come on, you're making me look like an extinct animal, so I want everybody to come up and hug me because I'm going to disappear. Our holding period is 16 years. So we have a 6% turnover. So we are bookends. We look at a company, we're buying not a piece of paper, we're buying a business. And when we want to buy a business, we're very fortunate on a global basis, particularly in the United States, in companies where the CEOs come to work every day and try to earn an extra return by beating up on their competition or enlarging the market. And so what we do is totally different. And I started watching the stock market when I used to caddy, and I'd go to a brokerage office, and what you're describing as a day trader, they would watch the tape, they would get a feel for how the tape was going, and they would try to trade stocks. That's like trading beans, and they can trade oil, they can trade commodities. We are buying a business. Okay, and what business should we own for the next 5 or 10 years, and what price do we pay for it? And in addition to that, when you're trading like they do, they have all sorts of tax gimmicks. Within the framework of what we do, we try to get for taxable accounts long term, but so that you only pay a 23.8% today tax rate as opposed to 44%. So it's not only what you make, but what you keep. In addition to that, we don't like leverage. We don't take any accounts or any clients that want to have leverage. If you're 28 and you don't have leverage, you're stupid. If you're 48 or 58 or 68 or 78 and you have leverage, you're stupid. Anyway, within that framework, what we try to figure out, if a company's public, what's it worth if I could convince these teammates here to buy the whole company? What would that value be in 5 years? And what determines the change in that valuation? And this is a very simple thing. It's you don't need to have PhDs working out of MIT with computers to figure this out. And so I love the idea of people buying mindless investing. I like the idea of them going and doing it all computerization because they, like you said, there was a stock that traded in Hong Kong one day. It kept going up, 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 up. And in 15 minutes, it dropped 85% because some computer guy said, well, what was it called, Hang Ang's Baba in Tokyo, it was a Chinese stock. And so you'll have all of these trades that malfunction in a computer system somewhere in the future. You'll have what they call fat fingers.
finger.
There was a firm in Stanford where they obviously didn't have the controls, and you can see something went wrong. Somebody, instead of buying $1 million worth of Apple, bought $100 million worth. The firm went out of business. So we'll have a lot more failures. This is good. This is creative. But that's what we do. And just to put it in a framework, if we everyone in this room owned all of the debt in the world, it would be 120 trillion. If we own all of the publicly traded stocks at 60 trillion, 65 maybe a little more now, maybe let's call it 65. So we're talking about a world in which we participate of $185 trillion. So whatever the style, whatever the methodology, whatever you do, just do it better than anybody else. And it's not complicated. You just keep doing it every day. It's like playing a sport. And
but one of the things I would add to that, I agree with you, and you know, SAC or .72 now is very unique. I would maintain, I would argue, and we see this on Georgetown's investment committee, and I think what distinguishes the Yales and Harvard returns is manager selection. And I would argue that the rule of thumb of 80% of managers don't add any value, don't beat their benchmarks, applies to hedge fund industry, because when the financial crisis hit and the tide went out, you saw these guys charging big fees, and all it was leverage beta. It was BS. And private equity, pretty much the same. So there's an 80-20 rule. So if there's one thing that I would throw out and leave with everyone, and maybe many of you investment professionals happy to argue about it, it's about manager selection. 80% of managers don't do anything for you except take your fees and deliver mediocre or worse results. And so that's one of the reasons I wanted these guys to describe what they do, because the real competition that endowment funds have and folks like Donnie who run a lot of money for wealthy individuals, you know, is how do you identify a good manager? You know, 9 times out of 10, if you just pick the guy who outperformed the last 2 years, you're getting it exactly wrong. There's much more to it than that. So remember, 8 out of 10 the deck is stacked against you. And so if you're not an investment professional, then you need to find somebody who has an understanding and gets close enough to know just what Mario really does. He hasn't really gotten into it, and same with Doug, because it takes days and days to go into our offices and meet the people and see how it really happens. You know, if there's a secret sauce, try to figure out what that is. Donna, you had a question?
So as a financial advisor, we've been attacked tremendously active versus passive. So my analogy when people say that is, in 1999, when the NASDAQ in 2000 dropped 80%, if you showed up the day after the bottom, index funds were good. And it took 15 years to get back to even. So I don't consider that an all-time high. The other thing is, in 08, showed up with cash in March of 09, all you needed was an index fund. If you do what Mario does, you find great companies, active managers do better and earn their fees.
Except for, let me repeat that because I couldn't hear it, so do it.
Go.
Oh, let you do it. You heard it.
Well,
I don't
think
so
that was a
I can't hear
question.
as well as you. That was a question and a statement and an observation.
I didn't hear a question.
The question is not complicated. It was a simple thing. If you bought an index fund in 1999, you didn't do well for 15 years. If you bought and had cash in 08, going into 09 and bought an index fund, you looked brilliant. So the question is active versus passive. So if you're in this room and you have to think through a simple question. I have a neighbor who just died in a car accident and I'm getting $10 million and the kids are coming to me and saying, how do I project for the next 10 years? Do I buy bonds? And if I buy bonds, do I buy US or non-US? Do I buy emerging market debt? Do I buy it actively managed or passively managed? What kind of returns do I want to earn? What's my inflation rate? What do I need in terms of stability, cash flow? If I buy stocks, do I want to buy against the relative performance? Do I want to beat a benchmark or do I want to be the benchmark? And then do I buy active management, which is going to hopefully add value to the benchmark after the incremental fee? Not a very complicated dynamic. And then if I do benchmarking, or if I'm going to do active investing, I might want an absolute return or relative return. So that's the dynamics, and some people have computer skills and they're gaming the system. The SEC is so far behind in regulations of allowing the front running in computers. It's just, it is what it is. The regulators will always be behind technology because they don't, they're staffed by wonderful, well-intentioned people. You know I was going, I know
Keep going, I love it.
Go ahead.
Over the last couple of years, if you would have invested in an S&P 500 index and paid a fee of 5 basis points, you probably would have beaten 90% of the people in the market. But if you look over the last 12 years or so, if you looked at some of the secular changes around the world, when China started to grow, you knew they were going to build more buildings. To build more buildings, you need more steel. You need more steel, you need iron ore, and to get it there, you're going to put it on dry ships. So an argument could be made that if you look at those types of secular changes and pick good companies in there, you would have actively beaten the market. In a fully priced market, at least in the U.S., be interested to see what types of secular trends or companies you see that you think are going to beat the market.
Did everyone hear the question? Terrific question.
You go first.
I did it before.
I know, you're on a roll, keep going.
I can jump in.
Yeah, all right,
I'll do it in a second.
I've never known Mario to be
Yeah.
shrinking violent.
Well,
Yeah,
there's 7.3 billion people in the world, okay? In the United States, despite the best efforts of our country, we have a real continuing problem, and it's healthcare. If you look out over the next 10 years, the aging population, people want to live longer, and they're going to take more pills to do that, and more importantly, you want to make them even live longer with personalized medicine, targeted medicine. But you go back to change behavior, eliminate smoking, that helps the problem, but also cut down the amount of salt, the amount of sugar in the diet. So who comes up with the substitutes? The second thing is the proliferation of taste on a global basis. How many want to eat Indian food? How many want to eat Chinese food? Who want to eat Italian food? Who wants to eat English food? Blah, blah. We'll hold the last one aside. Essentially, you look at so what do you buy that is a substitute or an enhancer or an ingredient or a flavor? And so you can look at that over the next 10 years and say that's going to work, but can you find something cheap enough? That is, what multiple do you want to pay relative to the earnings growth? And what if inflation picks up? What if it doesn't? And so you want companies that have pricing power in a deflationary environment, and you just got to keep looking. If you don't look, you're not going to find.
I was going to go to the same sector as the area that I believe in the most. If you take a 5 or 10 year view, now what you get from me is sort of a hybrid of the investing view and the consultant's view, having been working with these companies for a long time. It's really, I think, hard for us to fully envision all the possibilities that are associated with healthcare technologies. Each breakthrough, that tends to get valued on sort of what I would call 1 degree of separation, right? Either the drugs or the treatments or the techniques that you can sort of envision immediately from that breakthrough. But if you look back at history, it tends to be the first of many things, the extensions of the technology. And I think the market shows, just looking at the last 5 or 6 years, as lofty as some of these healthcare companies' valuations have been, they've been underestimated, right? The actual underlying value is much higher. And I don't think that's going to change for a while. Picking the right winning company, this company versus that company, is difficult. But as a sector, I think that we will have a tendency to underestimate the potential of healthcare technologies over and over again, at least for a while. I think that the other area that we will have a tendency as people or markets to be conservative about and underestimate are the effects of technology on retail behavior and consumers. Right? We are really, in my view, we are really just at the very front end of seeing what data can do in terms of more effective marketing, more effective pricing, more effective product design for consumer-driven industries. Right? I won't get this statistic exactly right, but this is pretty close. The amount of data that's been generated, stored, and is available for manipulation that has been produced over the last 2 or 3 years is greater than the amount of data in all of the preceding years combined. Right? So the explosion of data, we really are, in my view, at the very front edge of the curve of understanding what we can do with it. And again, picking winners is hard. Picking the winning company is hard. Picking the winning technology is hard. But to me, there's no question that there's a lot of inefficiency that you can. I mean, we could leave here if I said, let's go, we'll do a field trip, right? No one would notice if we just got on a bus and went around to a bunch of retail centers. If we did a field trip and just said, let's find retail inefficiency. Let's find food that goes to waste. Let's find products that are put on the shelf that don't move. Let's find wasted space in real estate. Let's find things that you've been advertising that's been pushed to you that you don't want to see. Let's find offers that have been made to you that you're not interested in. We could go to town on inefficiency. In 10 years' time or even 5 years' time, that's not going to be true. That won't be true. And there will be a lot of very, very good companies that form in and around eliminating that efficiency from the market. Those would be my two big bets.
Yeah, let me just ask one part of your question. Do you want to preserve your buying power in U.S. dollars or global dollars?
Mm-hmm.
You know, that's what you have to ask yourself. How do I protect against a government that's going to let's say not optimize the alternatives available to a free market system? And so do you want to invest in Monte Carlo? Do you want to have some property in downtown London, downtown Toronto? Do you want to diversify? Do you want to have cash flow from income like a global marketplace? So those are some of the subset. So you got to match what you're looking for with what you're trying to accomplish for the next 20 or 30 years. And if you just want to generically say, look, I got money there and I don't want to earn 2 basis points on T-bills, go to, what's that place, Mohegan Sun?
Bob, I would add, we take a different view. I mean, these guys are projecting into the future. Over 30 years, we've launched a grand total of 7 new strategies, and the idea every time getting back to being in inefficient markets and positioning yourselves in front of waves of change. I would say it's a lot more tangible and less esoteric than healthcare or technology, but infrastructure is going to be the biggest wave of change in the world today. And that's where we're positioning our company. The world has to industrialized world needs to rebuild crumbling infrastructure. Emerging markets have to build infrastructure for the first time. Countries like the US, it's not just our roads and airports, it's our pipeline system, it's our electric transmission grid, it's our entire telecommunications system, and as technology changes, that system's going to change again. The amount of money, you talk about trillions, there's tens and tens of trillions of dollars of infrastructure that has to be spending, that has to occur. Governments are bankrupt, whether they're federal or local. It's going to have to be financed through public markets and public-private enterprises. And you're seeing it with MLPs today, which are financing the redesign of our entire energy infrastructure. With shale, the gas has to go south, not north now, and it's constantly changing. And so there's going to be public companies. The largest owner of airports in Spain, 18 airports just went public, a hot deal. You're going to see the largest owners of cell towers, airports, toll roads, electric transmission grids, and so on. So the wave of change that is going to be the most capital intensive, in my opinion, for the next 20 years is going to be infrastructure of every kind, new and old infrastructure.
And let me make life simple for you. What you want to do is have good managements that understand how to adopt a change. You want to buy those stocks at a reasonable price. You want to have the individual that's running it have skin in the game. You want to have a company that generates a significant amount of cash flow, things globally. I strongly recommend Cohen and Steers for you.
How many shares of our stock do you own?
Well, you have no CapEx. You're paying a full cash tax rate. The government's going to reduce taxes to be competitive globally. You're going to get a big benefit from that. You pay a nice dividend. You love what you're doing. Why wouldn't I want to own a company like yours?
I love it. I'm just waiting for you to promote it on Squawk Box. This audience isn't big enough. There's not enough money here.
By the way, under your chair, there's a little envelope saying by how many shares you're allocated for Cohen and Steers with a discount.
Okay, on that note, any other questions from the audience?
Oh, please.
I just want to follow up on Don's question on the whole debate about active versus passive. And the recent popularity of passive, how much of that passive investing, how much of that do you think is a direct result of the fact that we're 7 years into a bull market now without any sort of correction?
Well, if everyone
Did you
didn't
hear that
hear,
question?
Could you guys hear that?
in my opinion, it's a result of a number of things.
What, can you repeat the question?
Well, the question is passive investing, ETFs in particular, has that enjoyed tremendous success simply because of the reaction to the financial crisis?
7 years in, yes, post-financial crisis.
Right.
Don's point. With
I-
7+ years of a bull market without any sort of correction. And during difficult times is when active management, I think.
That's right.
So,
The passive, let me separate passive from ETFs because ETFs have been tremendously successful because they're more efficient structures than a traditional open-end mutual fund. So, you know, the pitch for an ETF that, say, tries to mimic what Mario does or what I do, they not guarantee you, but you have high confidence that you won't do worse than the index. They charge a much lower management fee because there is no management. There are no capital gains and losses that are distributed from the fund, so there's less tax drag in that vehicle. But having said all that, I believe, I'm highly confident that within the next 2 years, what us active managers do, Steve may not care to offer it to the public, but what we do actively, we will be able to offer in ETF wrappers as well. So, and there'll be much less of a spread between the cost and the tax efficiency of active and passive because they'll both be offered to the public in ETFs. At the end of the day, I think that passive, regardless of how it's delivered, has been successful because a majority of managers haven't beaten their benchmarks, and it's really difficult for whether it's a wealth advisor or the head of the CIO of an endowment fund. It's very difficult to identify the best managers, and some of the best managers aren't taking your money. They don't, you know, 0.72 is not taking my money or your money.
Right.
So there are very few excellent active managers. They're out there, but most of them have disappointed the public.
Let me give you some numbers. The amount of money in ETFs and the index funds is probably 2.5 to 3 trillion out of the total amount that I just indicated of about 180 trillion. So it's got a lot more visibility in part because of the growth of Larry Fink at BlackRock, who's marketing his church, he's preaching his book, Invesco, who's Power Shares, and Vanguard. And, you know, they've got a collective mass of marketing that. And I used to be on a program with John Bogle, and I'd always say the same thing. John, how much are you going to be up in the down market? So the point of 6 or 7 years, I thought you were going to start preaching about Genesis chapter 41, verse 26. 7 fat years, 7 lean years, and therefore you don't want to be an ETF. But if you sit back over the next 10 or 20 years, what is the buying an S&P index? How much will you make? And how much is that going to be in terms of volatility versus another methodology of buying bonds? So if you bought an S&P over the next, if you think about the global economy, which is about 74 trillion, assuming it was all public, how much is it going to grow in real terms, in nominal terms? What happens to the gross margin of the corporations with labor costs rising, material costs? What's the SG&A going to increase? How much is pre-tax profits going to increase? What's going to happen to the tax rate? And then what's going to happen to the multiple when interest rates rise to that number? I'm in the camp that says, look, for the last 1927, to today, that index would have driven to you about a return of about 10%. In the next 10 years, I'm in a camp that says you're going to earn 6 or 7%, or 6 to 8%, including a dividend. So that's not bad. You'll double your money. So, for example, if all of us were here in 1624 and we chipped in $24 to buy the island of Manhattan, today it's worth about 7 or 8 trillion. That compounded rate of return is only about 6%. The holding period is a little longer than your perception. It's 400 years. Okay? So sitting here 100 years from now in Canterbury, the second 100th anniversary, what do you think you'll be able to earn if you buy an index fund? And what system of allocation of capital will exist? So don't be a short-termer and trade every 60 seconds, you said? So there's a difference in style, please.
Bob, wouldn't you agree, though, that in the discussion of the argument of active versus passive, the real nuance there is that the majority of active managers are closet indexers, and they're never going to outperform?
That's a great question. And so the question is, or I think it was a statement, aren't a majority of managers who are not outperforming because they're basically just hugging the benchmark and they're closet indexers? I think that's been true, particularly for firms like, and I hope I don't offend anyone, but J.P. Morgan, for example. They've got the Pierpont funds, they've got these great brands, and they've got a captive wealth management audience, these trusts. And so their instructions to their portfolio managers are, it's our game to lose. We just don't want to screw this up. So hug the benchmark. That is changing rapidly, and there's a new metric in our world that all the consultants, the biggest pension funds in the world, are latching onto, and it's called active share. And it's a single number that when you analyze portfolios, and soon every mutual fund, you'll see a data point called active share. And that number will tell you in the aggregate of all the holdings in the portfolio how much it diverges, how different it looks from the index that it's competing against. And so in Europe, for example, the regulators that regulate the big state pension funds there are themselves deciding they have measures of active share, and even though you're an active manager, if your active share is not high enough, they will designate you as passive and not allow you to collect active fees. So yes, that phenomenon I think is very prevalent, has been, particularly in the big trust companies and places like that where they have captive assets and they just don't want to screw it up too bad. But that's not going to work. Again, they're facing their Kodak moment also, because there's going to be much more transparency. People other than investment professionals like you are going to become aware of this, and it's not going to be acceptable.
I'll make a statement that'll probably please about half the room by my eye, maybe a little more than half the room. I think that you remember earlier Bob was saying, if you're having somebody manage your money, take the time to get to know who is managing your money, like really get to know who is managing your money. I think the next few years are going to strongly favor investors who have been around for a while. In our firm, a lot of our younger investment professionals, really their entire investing experience has been in this last 7-year bull market, and this market has been quite extraordinary, right? You can't find, you have to go very far back, and you probably have to piece together different eras to find a point in time when the government has been as active stimulating the market, when interest rates, particularly here in the US, have been as low as they have been, and when the multiple expansion has been as sort of relatively consistently and smoothly forward walking, right? I think that somebody whose entire investment experience has been in this window of time is probably not going to be well prepared for what the next 10 years is going to bring, because I can't predict what the next 10 years will look like, but I think there's almost no chance it's going to look like what the last 7 years has looked like. I am alarmed. I hate to feel like the old guy in my firm, but I'm alarmed when I sit down and talk to some of our young investment professionals about what happened in 1999 and 2000, how unfamiliar they are with it. It's very, very eye-opening. So I think that the next couple years are going to favor the experienced and the seasoned.
Do you care about benchmarks?
No, I basically am trying to, my benchmark is a 10-year treasury bill adjusted for inflation. We're trying to do absolute returns. Our goal is to generate 10% real plus inflation without leverage over an extended period of time, and that's our benchmark. However, nobody likes us because of that, because they want to put you in a style box to check you, and it is what it is. So that's why we have to work every day to try to survive.
So it's really the difference between managers who are looking to achieve absolute returns versus guys, again, in the JP Morgan example, who are just playing relative return games.
Yeah, but they're very good. They have extraordinarily good talent, and they ask their analysts to pick a benchmark and then ask who covered that industry and try to add value to that benchmark. Everybody is trying to do something different, and the more people that compete in the system, the better off we all are collectively. And the more that everybody indexes, the happier I am. I hate to say this, because of what somebody said before. Cisco in 1999 was 15% of the index. I like that. And Cisco has done quite well over the last 15 years, and it's still half the value it was 15 years ago. So
Yeah,
the more that buy the index fund, I'm not unhappy about that. And it's not a bad way to invest. I mean, I can't knock it. I happen to, we're going to start a non-transparent, actively managed ETF because of the tick marks that you highlighted. On the other side of the coin, if I was running the Investment Company Institute, I would try to get them to change the way the mutual funds are taxed. Right. I mean, there's no reason why an ETF has a tax advantage. They have a tax advantage because they're new and nobody's figured out that the mutual fund people can change it.
As you said, the SEC's 20 years behind.
No, but that's the IRS. They are very good at keeping data secret. In Cincinnati, I don't want to get there. We're not getting there. We're not going that way. We got one in the back that wasn't asked.
What are your views on private equity? One, just as an alternative to companies versus the public equity debt markets. Number two is actually kind of fostering somewhat longer hold periods and growth of companies. Reason, from your perspective.
Private equity. You want?
I can take. So, as a generic view, I think there's still a lot of opportunity. Well, let me back up. There's a lot of different flavors of private equity, right? There's sort of, when people say private equity, I think most people sort of conjure the firm that buys highly mature, tend to be not necessarily end of life, but tend to be kind of end of S curve companies that are better. The argument is that their growth rate is slowed down, so that they're better funded by private money than they are public equity money with the expectation. So if that's what you mean by private equity, I actually think we're coming out of a period where private equity has been a little tough, and it's probably likely to get better going forward. I can tell you we are allocating more of our funds of the family office toward private equity looking ahead for the U.S. market.
Are you starting your own funds, or are you basically?
We have a private equity fund internally. We don't.
Okay, so you do your own deals,
yes,
as opposed to giving it out to others.
Correct. Yes.
Okay, so you like that. Good.
Yes, and we think we're going to like it more.
What don't you like about private equity? What was the next phase?
Well, the comment I was going to make is I think private equity has had a fairly tough run for a while, because there was so much money pushed into private equity. The markets do tend to top tick these types of vehicles, and there was so much excitement about private equity and a lot of money pushed into private equity that a lot of deals got chased that were probably not very good deals. They got either overpaid or just not the right expectations for the deals, and a lot of funds underperformed as a result. So. And I frankly think it was the market has been growing, and of that classic sort of low growth private equity, I just don't think the proposition's been as strong. But if you take a forward view and you say, I don't think the market's going to continue to expand this way, I don't think the growth is necessarily going to be as strong, it's probably going to have a bit of a comeback. That's my view, and that's our view around how we're allocating our capital.
Yeah, I was in the private equity business in the early. When I actually started in the 60s, we were doing it was called bootstrap financing, then became LBOs. And we were in the business in the early 80s, and we got out of it, not because we didn't believe in it, but because when we made a bid for a company, the name I remember is GATX, companies that we wanted to do research would come to us and say, you're here to buy us or invest in us, so we decided to be in the public markets. We'll be going back at some point into the private equity, and the reason is fairly simple. If a company's private and they want to re-leverage, we want to be in that business. If a company's public, we have a moral obligation and a fiduciary obligation to buy for a client that we manage money for. But there are enough companies that will be privately owned that we could figure out how to re-leverage, and we do it now. So I don't see anything negative about private equity, and in fact, if we buy a company, there's one here I can't buy because I own it in our mutual funds. I can't even think about it, but I'll give you the name. It's called Eastern Enterprises. Stock's $19, 6 million shares. I walked into the company. It's in the Naugatuck, Connecticut.
Mm-hmm.
And
You say so.
I drive into the driveway, and I happen to have another meeting somewhere else in East Windsor. I'm driving back, and I said, I gotta see another company. I'm an addict for seeing companies. So I drive into the driveway, no cars. I walk in, no people. Everything has not changed. So I go to see the CEO, and I say to him, I just stopping by. I hadn't seen you for 10 years. He opens a book. He says, Mr. Cbury, the last time you were here was 1992, 22 years ago. The company has been managed for cash, not economics, has done absolutely nothing. He's 85 years old, a nice CEO, but he hasn't done anything. I would love to own the entire company and buy with 3 times debt on the EBITDA. They have little capex. I borrowed two terms from mezzanine, and I think we'll earn 35% rate of return. I'm pitching you, Doug.
Yeah. We're following up. I got it.
Just EML is a symbol.
I have a different view. I think there's probably nobody in this room that should own private equity. Private equity, you have to be willing to lock yourself up for 5, 7, 10 years.
No, only 10 years.
Yeah.
10 years. Private equity is one of the most crowded trades in the world today.
I still agree with that.
There's more money chasing private deals than ever before. When the energy market blew up in the fall, the Georgetown investment staff said, oh great, finally there's some distress in the world, and let's go find some great managers to invest, take advantage of it. Howard Marks at Oaktree or whoever. And the high yield market is so liquid that they came in and all these energy shale guys and drillers could refinance in the high yield market and this market and that market. And so I think like anything, you have to pick the right manager. When I became head of Georgetown's investment committee, we found that roughly half of the private equity investments we inherited were crap, and we ended up selling them at NAV because there's $30 billion looking to buy secondary units of private equity funds. And so manager selection is critical. For most of us, just individual investors, the only way you're going to get access to a great manager is through a fund of funds or something like that, so you're going to pay double or triple fees. Vintage is almost everything. In real estate funds, vintage trumps everything. You got to get your timing right, or you could have Blackstone, you could have Superman, you're going to lose. So it is a complicated, challenging endeavor. There's never been more money chasing private equity. Valuations, in my opinion, don't look great unless you have a niche manager who can buy, say, an auto parts supplier that the big private equity firms don't care about. You can reposition them or re-leverage them, but I think unless you're a pension or endowment fund and have a staff and have size and can worm your way into these great managers.
Why wouldn't Canterbury have a fund for private equity where you have staff and size and take a little fee for?
Well, ask Donnie over here. Donnie helps us with our investments, but we don't have the scale. We'd like to have the scale, and we're open to it. We're open to it.
Somebody was at the entrance to the door before, and she said, "What's this panel about? Is this about a money panel?" And she walked away.
Show me the money.
Somebody had a question we didn't get to, was it?
I
Bob?
have a question.
Yeah.
Your comment about a lot of younger people who've been in the business for the last 6 years, a lot of them have gone long, and the market's been great. Is there more of a looking over the next 5 to 6 years, is there a rationale for investing with a good manager that have a long-short platform?
Well, I mean, obviously, I believe in the long
Can we
short platform
broaden that
because I'm here.
question? So you're talking about hedge funds, and I think the first question, not to supersede you, but it's a big thing with me is people don't know what people refer to hedge funds, whether it's long, there's 100 different flavors of hedge funds, but investors and individual investors talk about hedge funds as if it's a growth stock fund. It's one thing.
It's not
and
that.
so maybe, Doug, I mean, I think you two are in that business,
Yeah.
I'm not, so maybe talk about what is a hedge fund and why do we care?
Right. So there are a lot of different flavors. The easiest way to think about it is a hedge fund is a fund that is let's take it down to an individual portfolio. A hedge fund portfolio is a portfolio that's constructed so that you have long investments and short investments at the same time, that they offset each other. There's a bunch of different theories or approaches or strategies around how to have them offset each other, but the combination should pull away a lot of the things that you can't control. So I'll give you an example of how the strategy that we have most. We have about 65 individual portfolio managers. We don't dictate their strategies, but we tend to invest behind strategies that we understand and like. A pretty common approach that we like would be somebody who has constructed their portfolio in such a way that they have eliminated most of the general market movement and most of what I would call the factor market movement. So a factor might be funds that try to invest in all earnings, high earnings yield companies, or all growth companies, or something like that. We like to see those factors hedged away as well, so that what you get by hedging those factors away are the movements of the underlying individual equities, sometimes relative to one another. Right, and there are, this is going to sound really simple, so forgive me if I give you something too basic. The most easy way to understand a hedge trade would be what's called a classic pair trade. Are you familiar with the phrase pair trade? So let's say that I think IBM's a great company, and I think and has a lot of forward potential, and I don't think Hewlett Packard's a great company, right? I would buy IBM and short Hewlett Packard. Now, what does that do? Well, they're both in the same market, the U.S. equities market. So whether the U.S. equity market moves up or down doesn't matter, because if it moves up, I make more money on IBM, but I'm going to lose it on the short on HP. If it moves down, it'll go the other way. They're both in the same sector, right? So they are, more or less traded. So if people are moving money into that sector or moving money out of that sector, doesn't matter. They'll move up and down together. They're both large caps, big companies, right? So again, whether money's moving into or out of large caps, they'll move up and down together. And they both pay a dividend, so they both have a sort of an earnings and dividend orientation. So again, money moving out of that. So what I really get by buying one and shorting the other at the same size is the differential in performance between the two companies with everything else stripped out. Now, why do you do that? You do that because you can take on a lot more leverage. If you take on a lot of debt, if you lever up to do your investing and you have a lot more exposure in your leverage, if you get it wrong and the general market moves on you, you can lose everything. And that happens. You see funds that go out of business because they take big directional bets with a lot of leverage and they blow up. So that's where hedge fund really has come from.
Let me see if I can put a little different spin on that. Right now, we talked about the ETFs, like index funds. Hedge funds are about $3 trillion. They were started by go back to the late 1940s. It was Alfred Winslow Jones. Warren Buffett was in the hedge fund business. And then in 1967, when I graduated, I didn't take my 3 months off to go travel. I went to work on Monday. I graduated on Friday. The guy that quit was Michael Steinhardt. Steinhardt had the most successful hedge fund for the 16 years he was there. And, he retired in 1994, and he's made more money since. But essentially, they're trying to generate an absolute return.
Right.
And the reason they want to generate an absolute return is they get paid a percentage of the profits. If you're down 2% and the market's down 20%, that is not a profit. They would have a high watermark That is that they won't get a return extra until they pass it. So they want to make money, and they want to make real, absolute return. That means you want to be up. And the way they do it is to do a variety of techniques, and each one is somewhat different. And Doug explained the paired trade, the General Motors selling GM buying Ford type approach. And there are a lot of ways to do it, and all of them can be successful. The problem is, as you somebody identified before, in a good question, that was a good question as well, is that in a year when the market's up 40 and they're hedged, and they're up 20, they're dancing to the bank. They're happy, their investors should not be unhappy. And if their investors are unhappy, like CalPERS, they have the wrong product in their portfolio.
Yeah. Invest in the wrong thing.
So that's, you have to match what you want with that. To the degree that you now believe in Genesis 41, chapter 26, that there'll be some lean years, you may want to have more of an emphasis on short selling.
Right.
And so that's the question mark for you. Customize your own portfolio and your own needs with regards to what you want to do. Steinhardt, by the way, if anyone really thinks that they could walk on water without some outside help, think about the following, that in 1969, there were 150 hedge funds that were then tracked by a reporter by the name of I was going to say Cynthia Loomis, but at Fortune, and they published what they did in 1993. Only one out of that number was up. Many went out of business. So the fact that you have smart people, and there were smart people then, and there's smart people today, and there's smart people in this room, that's no degree for success. And so you just, take your portfolio and, well, you can say, no.
But I think you have to think about hedge funds. Are you looking for a strategy that's going to enhance returns or reduce risk? And in particular, today, I think the Fed has succeeded in creating a world where everything looks expensive. If you sell stocks, what do you buy? If you sell bonds, where do you put it? And I know at Georgetown, again, it's really hard to find the good absolute return managers. So if you're worried that stocks, everything's expensive, if an absolute return strategy is excellent right now. It keeps your powder dry, you can earn some return if you get the right manager.
But you have a problem at Georgetown. You don't have.
We don't have enough money there either.
I agree. But you have a high
Not as much
problem.
as BC anyway.
No, irrelevant. And the point is, I'm on that investment committee for the last 20 years. That's why he's needling me, or 25 years. The point I'm making is that you have to take a certain percentage of that endowment out, 5% a year, to contribute to the budget.
Mm-hmm.
And whereas you don't need to spend that much money because you probably have other sources of cash flow. So you have a totally different mindset as to what you want to do with your net worth versus your cash flow. And everyone has to figure out what they want to do and customize it for themselves. And it's not that complicated. If you're going to go play golf, you got to have a club. Or what else do you use?
You kick them. You kick the ball. You have a shoe wedge.
You need club balls. That's it. So
that.
you prepare for the game, and so you practice or something like that. He's a good golfer, and the same thing with regards to your own personal financial situation.
He's trying to sell me companies. He's trying to set you up for a match. So.
Yeah, I want more strokes.
He's trying to sell my company.
I want to merge. You want me to give you a kiss here?
Tonight, Mario. Other questions? Yeah.
With the Fed set to possibly raise rates later this summer and the fall, how do you think that's going to affect your business going forward?
Great question. My own reaction is the market is not priced for a sharp increase in U.S. rates. If I were, Janet Yellen has to raise rates at some point in time. The question is when and how quickly, and signaling to the market will do that. The last couple of weeks you had a big move on Monday when the Greeks were going to say in the EU, on Friday went down sharply, and then you have a trade agreement. It's a lot of background noise, and my own reaction would be it would be wonderful if they raise rates. Is the market prepared for a sharp increase of 50 beeps on the 10-year? No.
No.
And if they do something quickly with something like that, if it happens for some accident, you'll have I'm just waiting for that, 10% down, 15% down in the market, long overdue. And if that happens, the question is, what's the other side look like? So we know that where we have $4.6 trillion of the Fed balance sheet, we know that the Bernanke's and the Yellens in the U.S. and the Draghi in Europe and the Coronas and the guys in Japan, this is the world. They're all trying to reflate. It's there's some unintended consequence that's going to have some bad outcomes. But who knows?
Given the nature,
I don't know if that answers your question. Bob wants to jump in.
I was going to say, given the nature of how we invest, it won't affect us much, but I think it is going to affect the U.S. markets if there's a sudden move. I was looking at the chart literally yesterday, and was stunned. It showed kind of like a 25-year chart of Fed interest rate movements, or Fed rate movements, and I was amazed at how little there has been for the last 7 years on a relative basis. The market has gotten very used to, truly either a no tuning knob or like a very, very fine tuning knob. I think if there were a big adjustment, it would be a shock.
I think Fed watching is just a total distraction and is a complete waste of time. I agree with Mario. I mean, what difference does it make if the Fed increases the discount rate 25 basis points? As we're sitting watching the Fed, the 10-year's gone from 1.8 to 2.4. That's what you need to keep your eye on. And more importantly, what is it that's moved it? It's not the rate, it's what is driving it. And to me, the delta that we've seen is that you are starting to see wage inflation. And we're basically at full employment for skilled labor. And that's why you're seeing wages go up, and that will sustain an increase in inflation. That's what you should keep your eye on. Now, that suggests that the economy is strong and improving and will continue to, so that'll have different implications. There'll be cyclical companies that actually benefit even if rates do move higher because their earnings growth rates are going to move that much more quickly. There'll be others that don't do well. Utility stocks, bond-like investments are going to get creamed.
I don't know if you wanted to flush that out more, because that's the question that everybody will be talking about, these things on television that Bob is going to go on and he's going to talk about them as well. So flushing out your ideas would help him.
It helped me a lot.
And all of us.
I think I can't resist. This is not don't invest in what I'm about to say. This is, don't put any of your own money at risk at the theory I'm about to share.
Well, I'm going to ask you specific places then to where to put money.
One of the things I think is going to be the most intellectually interesting, this is the consultant in me speaking, most intellectually interesting to watch will be what happens as we feel inflationary pressures over the next few years, given that we haven't had inflationary pressures for a long time, and there has been a very significant change from the last time we were in a higher inflation environment, which has been created by the internet and the availability of information online. I was talking to somebody earlier who works at Kayak, or works with Kayak. Is that you? You working? Somebody worked at Kayak. I don't remember who it was. Think about the tools that you personally are using now to compare prices of things of different types, right? And you are not out of the norm, right? And if we were a much younger group, if we took 15 years off the age of everybody, if we were a much younger group, that usage rate's higher, right? For a lot of young people, they would never conceive of buying something that they hadn't used some sort of price comparison engine to determine whether it's there. So I think it'll be very interesting to see how inflation propagates now versus how it's propagated in the past, because this is one, consumer areas especially, this is one area of the world that is definitely different now than it was 10 years ago.
Yeah, but I'm in Bob's camp, and I think when you go back to 1982 when Ronald Reagan came into office, inflation, I bought a 10-year bond at 14 and 7/8 coupon, and it dropped after he basically fired all the air controllers, and that broke the back of inflation. Today with Target, Walmart raising wages, LA just raised the minimum wage, and with the labor market tightening, wages are going to go up. And as that goes up, you basically would start baking a cost-push wage inflation into corporate mindsets. And I'm Listen, I think buying at wholesale is expensive, so I like things at distressed pricing, but I think inflation's got to accelerate.
Oh, there's no question it'll move up, but I think I'm saying the movement is going to be different than it's been in the
Always
past.
is. Doug, we want to ask anybody.
Yeah.
You made a comment about careers on Wall Street going into the .com world, but my observation is not complicated. Whatever you do, you're going to be successful at, but have a passion and have fun. And so, to me, I'm overworked and overpaid, and I'm going to stay that way. But Bob,
And you love it.
and I love it. I mean, I like reading annual reports. It's seeing companies and having intellectual moments with managements.
No, I couldn't agree more. I think, as we meet with young people looking for jobs on Wall Street, identifying that passion really is, I think you hit the nail on the head. There's a lot of smart people in the world. As we've seen with our president, just because you're smart doesn't mean you're good at your job. And
You got one freebie, I had one freebie, no more freebies.
no more freebies. But you want someone with a passion for what they do, because without that, you're not going to be very good at it. I think that's it for us.
Anybody have a question? One last
One more. Yeah, one last question.
I have a question. Do you folks, I guess, I've always learned that investing, I'm a very individual investor, that you're supposed to invest in something you believe in. My theory is if I can make money, I can make money. So, how do you feel against most of what Doug's good companies, like, you believe in your product?
In my product.
Well, particular stock.
Oh, do I believe it? So again, I'm going to wind up reflecting on my time as a consultant. One of the things that Bob and I wouldn't disagree on at all, I tend to believe in management teams. I tend to believe in the people who lead these companies. I have seen great management teams take over terrible companies and turn them around. I've seen them overcome difficult markets. I've seen, finding a way to win, and I've also seen terrible management teams essentially be dealt a great hand and blow it. So I strongly believe in management teams. I think that any good active investor who doesn't go spend time face to face with the management team and really understand the leadership of the company, their drive, their passion, their insight, their the way they work with each other, I would never want my money being invested by somebody who doesn't do that, because it really, in my view, does come down to leadership. And I do believe very strongly that leadership ultimately trumps all the other things.
Would you agree with that?
Me, I'm in the camp of Cinderella. I don't believe a prince can kiss a frog and turn it into a princess. So if you have a bad business model...
I'm not sure that's how that worked in the story.
Well, however it works. It's my story, Doug. You basically...
Your version's a little creepy.
If you have a steel company and the Chinese are cutting price, and unless something happens, I don't care, you got the best management parachute in the world, they ain't gonna do anything about it. So if you have a good business run by good people, you'll do well. But he didn't give you any ideas to buy.
No,
I thought that's what you were asking.
No, well, I've been investing in stocks since I was in the 20s. So,
That was 4 years ago. So what are you gonna do?
For example, I would put stock in ammunition. It's against my moral judgment.
Ammunition.
Yeah,
It's a
it's
tough
a
one.
moral judgment, but I'm a capitalist.
Look, I see a lot, both at our company, at Georgetown. There are some tremendous movements out there. A lot of student groups pushing to divest from all fossil fuel-oriented
Yeah.
companies and things like that, and it's real. Georgetown just last week announced that we're divesting from any companies that are in the coal business. And so there's, in talking about the latest generation, younger folks today, socially motivated investing is an incredibly powerful wave of change, and it's going to affect investing more and more over the years, both where the money goes in and where it's divesting from. It's real and it's growing.
I think that's true.
Well, thank you guys.
Thank
It's
you.
been awesome.